Well, what we're going to talk about today is specifically around some trends that is going on within your industry. We'll then talk into three of the questions that you asked us to come today to talk about. One is the valuation of Fastlane. Two, how does the valuation compare to the Autobahn offer? And then three, we'll go over some strategic alternatives that we've come up with. And then our final recommendation. So we look at Fastlane in two distinct businesses, one in the US and one in Europe. If we look at the US business, your dealerships are in some of the most wealthiest cities and counties in California. We also look at in the United States that there's a rising consumer confidence. You also have aging vehicles. In fact, in the next 4 years, the unit sales is going to increase between $12 million and $16 million. This is quite the contrast to the European operations. In Europe, with the Eurozone issues, you're still suffering from an ongoing recession. We still have issues with credit. We have a high unemployment rate, and there's excess capacity in the marketplace with a lot of cars sitting in inventory on dealership slots. At the same time, manufacturers are reducing capacity and laying off workforce. So we truly believe the best offer to move forward is to divest Fastlane AG at a minimum price of $60 million. Now, how and why did we get there? What we wanted to do is triangulate the evaluation in a couple different ways. The first method we used was discounted cash flow. We looked at your future net present value of your future cash flows, and this came up with a high-end valuation for Fastlane of around $147 million. We also looked at the industry standard Blue Sky method, which took in consideration a pre-tax income times an industry multiple plus your net tangible assets, and this came in at the low end of around $102 million. Now, what we also try to do is, because private equity is interested in getting into the industry, and it was another way to benchmark the other valuations, we looked at a leverage buyout as well. And based on the rate of return, the valuation for LBO came between $100 and $140 million.
Just some notes on these calculations that we did. For our beta value and our average cost of debt, we took similarity comparison amongst the businesses that you provided to us. And we used a weighted average of the most similar businesses for both the average cost of debt and the beta. So that's what we were using to calculate our discounted cash flow. For the Blue Sky method, we used a multiple of 7. If we were just looking at Fastlane Inc. in the US, we'd actually probably push for a higher multiple because the market is performing so well and expected to get better. Because Europe is dragging it down a little bit. We use 7, which is still at the high end of the model that was provided. It's German luxury cars are what you sell, and German luxury cars are what people want to buy and what other companies want to sell as well. So we think it's a fair valuation to use with that multiple.
And we did also make a couple assumptions for the leverage buyout option. We do have that the balance sheet is going to maintain the current levels going forward. And we did make the assumption of a 50-50 split between debt and equity. And what we did there for the debt is we took a rate of 5% and then put a little bit of prime on top of that, so we came out to about 5.3. So the LBO that we have referenced here of 100 to 140 million, that is after debt, and the internal rate of return that private equity would receive, those amounts would be anywhere from about 21 to 26%.
So 140 to 100 million is the range. Now, where do we go from here? Now, in comparison to the Autobahn AG offer for the entire business, it was $160 million, not assuming debt. So if you take that out, net profit for the shareholders would be around $99.7 million. We believe, because of that, because it's a low-ball offer and at the low end of the scale, that we should reject the current offer as it stands.
And something to consider with our discounted cash flow value of $147 million is that's excluding the debt that you've already got. It's not being taken into account, or it's actually been taken into account already, and that valuation is on top of the debt that you currently have. So that's your total business after the debt's been paid off. So to have to cover your debt with just the $160 million is actually netting you much less than your business is worth.
So would you reject it and wait to see how they come, or would you propose something in return?
We're going to get to that next. That goes into our strategic alternatives. Again, going back to what we initially said in the first part of the presentation, our first primary strategic alternative is to divest the Fastlane AG European operations. Now, what we wanted to do is specifically look at the valuation for the European business alone, and we utilized DCF and Blue Sky to do that. And that range for Europe was around $43 to $48 million for Europe alone. Given the synergies that Autobahn, number one, they're highly motivated. They want your European operations primarily. They don't even want anything to do with your US operations at all. But given the fact that the synergies over the next 5 years is $7.5 million by reducing SG&A in Europe, we believe at a minimum you should get around $60 million for that European business.
And again, with these figures, we use the same models for DCF and Blue Sky, but we did adjust. With DCF, the average cost of debt was actually a little bit higher in the WACC figure because of the different distribution between debt and equity in the European business. With the Blue Sky, we used a lower multiple, as we mentioned earlier, that the European market being slower and showing less growth, a multiple adjustment of 2.0 is standard. So
when you say a WACC figure, what do you mean by that?
The weighted average cost of capital. It's the distribution of equity and debt in your business, and essentially it brings out what the cost is of each dollar that you borrow. And that discount rate gets applied to our discounted cash flow method. So over the course of the business, or of the future, the discount rate that we applied, which was 9.32 for this model, is what adjusts your net present value that we arrive at.
And what kind of debt structure did you assume there to get that weighted average cost of capital at 5.3? I mean, do you have senior debt in here plus junior capital sub-debt measures?
Those weren't broken out in the figures that you provided to us. So we just had your long-term debt, and any long-term operating liabilities were excluded from that.
And because of the synergies, and also because your main goal is to diversify and get some liquid in your investments, this is the primary recommendation. Now, moving on to the strategic alternative 2, kind of answering your question, would we go back to Autobahn and negotiate with them? We think this is a lower option for us, and basically what we would do is start out with the $160 million offer and go back to them and see if they would assume the debt on top of that, bringing the total deal up to $220 million.
Now, something important to consider over here is that with the downturn in the European market, credit terms and lenders have become really stringent in the terms. So a deal of this size, we're looking at $220 million if Autobahn assumes the debt. A deal of that size, in the past 10 years, there have not been too many deals that are taking place of such high value. And even if Autobahn comes up and accepts the offer, it might be difficult for us to materialize that money in the next few years if any kind of economic downturn takes place again. So I think I would support what Chuck is saying, that divesting European operations make more sense right now.
Yeah. Moving to strategic alternative number 3 is maintain status quo. Now, what you would gain from maintaining the current operations is that you would achieve, because there's still growth in US and Europe, you would still see some profit from those businesses moving forward. And then the uptick in the US business, because of the unit sales, and unit sales helps increase used car sales and service sales, there's a ton of profit to be had in the United States. Now the cons on the other side, it doesn't hit your main goals of diversification and liquidation of your investments.
Now, backing up to what he's saying, while this might not be the best option, is that euro is at a good value right now. It's one of its high values to look at. And if you're looking at divesting just the European operations, we might be getting a better deal because of the difference in the currency valuation. Again, looking at the market instability which is there right now in the European sector, if we wait for a couple of years before divesting this business, we might see some economic downturn which might lead us to risks of foreign exchange, rate of return, or risks with economic downturn over there. So I think divesting the business is one more reason to support the divesting of European business.
That's a good point. And then on top of that, the market today, it's a seller's market. So if you wait a couple of years to divest any part of your business, the market's saying it, more and more auto dealerships are going to get in a marketplace to try and sell their businesses to strategic buyers or other private equity options. The fourth alternative that we came up with is going to private equity. Now this is an option, but we feel that the transaction is likely because private equity is not going to see the synergies that a strategic buyer would see in your operations in Europe or the US.
And looking here under the consolidated operations under Model 1, you see the 220 figure that we were going to go back to Autobahn with, if that was the option, and netting the 160 million. And that's going to give an internal rate of return of about 19%. Most private equity companies are looking for anywhere from about 20 as baseline to something a little higher. So we think 20 to 25 would be the range. And the 200 to 160 value, we think it's just too low for what we valued your company at. Now, if we just look over at the Fastlane AG, we have the range of 50 to 70. And we did say coming in at the base minimum of 60, and it does look like an internal rate of return, which is pretty good for private equity at 23.5. However, they are going to assume some risk in this market. So we think they would actually be wanting to look for something higher, maybe like 25 to 30% internal rate of return. So that's getting anywhere from 50 to 55. And again, we think that's too low for what your company is valued for that European market.
And on top of this, going back to Kaustub's comment earlier about the probability of this transaction happening, because there's only been a couple deals over $100 million. More of the deals that have happened in the M&A space have been in a range between 50 and 100. So we feel that the sale to private equity for the entire business would not make sense at this time. So going back to our recommendation in selling Fastlane AG, we truly believe you have a highly motivated buyer today. They want your European operations. Because of this, sell the Autobahn AG, the European operations, and then maybe in a couple of years, after you realize the growth in the U.S. market, maybe reassess the U.S. operations for sale over the next 2 to 3 years.
So I'm confused by something. By the way, the financial people are down there, so maybe it's why I'm confused. So sell our European units off for somewhere around $60 million, where they actually gain efficiencies in acquiring that because they're already in that market. But then you put the total package at 220. Why do I see that differently?
Well, our primary recommendation is just selling off. We feel that the primary recommendation is just selling off the European operations. If we go back to Autobahn AG to add on that $60 million, assuming the debt, we feel the probability of that happening, it would not happen. I think it's part of our negotiation strategy. Maybe we do start at the high end and then work in negotiating just for the European operations only.
Europe's a much more stable market as well. So while the numbers still look good and there's still growth shown, when back on a few slides we have the projected net income for the two businesses. It's much, much less in Europe as opposed to the US. And a business like Autobahn that's already over there can realize these synergies. It's more valuable to them, but it may be a harder sell to any other company or private equity out there.
And then you did mention that the diversity and liquidation is what you were looking for. So this would give you the piece that doesn't have as much growth. You would be getting rid of that piece that actually is pulling some of your net numbers down, and you would still get the liquidity and growth that you're looking for. Diversification.
So when we talk about the European synergies, has your firm done any kind of calculation to quantify those for adjusted EBITDA purposes, anything like that? When you're looking at the two, U.S. and Europe separately?
We did not calculate those specific numbers. What we calculated is the synergies over the next 5 years and then savings of $7.5 million, $1.5 million per year. Okay. That's what we use in our calculations.
And then based on the 47, adding that 7.5, and then taking it up for the other things that they would recognize by increasing their market share and that type of thing. That's where we put it at a minimum of 60.
Did you adjust EBITDA for any one-time, non-recurring events, anything like that?
We did not.
Okay.
With our blue sky calculation, we do feel that's more conservative because there were the one-time operational costs in the previous year. And again, because that's at the lower end of what our valuation was, we realize it's low, but even adjusting for that, we still feel that discounted cash flow shows a higher value and value that is in the business.
What's the timeline and process that we go through to close this transaction if we want to pursue it?
Yeah, we feel, going back, and that's what we're going to cover next, is the fastest, because your goal is to get some diversification and liquidate some of your investments, we feel the fastest way to go is option one of proposing the sale of just Fastlane AG to Autobahn for just the European operations only. And then secondly, if they don't want to negotiate, if they have come in an offer below 60 million, we believe we should do a control auction to these other strategic buyers that will see the same operational efficiencies in your European operations today.
And the way we came up with these strategic buyer alternatives was that these are publicly listed companies. So we looked up the financials for these companies and looking at the debt to equity ratio, the amount of cash that the company owns and the amount of debt that they have. Some of these companies do also have similar geographic footprints, so it might make more sense for these companies to look at purchasing the European operations, because they might realize some of the synergies that we've seen with Autobahn right now.
How do we protect ourselves if we go down the path of selling to Autobahn and they start looking at all of our due diligence materials? I mean, they're gonna get into all the details of our company. We're a competitor, right? They're a strategic acquirer. What happens if we have a failed transaction and then we go back out and we try to run a broad auction? What's going to happen, in the auction world in terms of valuations? Are you anticipating valuations having to come down because word on the street is that the Autobahn transaction broke down?
It really depends. We feel, based on the information that we can definitely get, based on the information we have today, that with the 60 million as the minimum offer for Autobahn, that's definitely the way to go. If there's anything that we don't know about just yet, we don't see anything coming out of the closet just now, but that we don't know about, but hopefully that does not happen.
And there's very little to suggest that Autobahn would want to walk away from this. Their primary offer, it insinuates that they're not really interested in our U.S. operations at all. They're trying to buy the company to get Europe.
Yeah, just run it status quo, keep the management team, and just let it ride. And
if they're willing to pay 160 for the entire operation, then asking for less than half of that, which is even a high valuation here, if we said 70 or 80 million, and we think that there's definitely support to get a price up in that range based on the synergies in their strategic.
Is there any value to conducting a limited auction now?
It would delay your transaction at the very least.
Yeah, you would have a little more competition in there and you might drive the numbers up. So it's purely a timing standpoint. If you're looking for more, the speed in the transaction, you already have Autobahn who is interested and has looked at your numbers and that type of thing. So.
And that's why option one, Autobahn's highly motivated right now for your European operations. And then start there and then go to option two, to the control auction, to the other strategic buyers.
And even if you look at the financial information for our Fastlane AG division, it does have growth, but the growth is not as substantial as the US market. So it doesn't look like the market is going to perceive our business as a risk for the European market. It's a stagnant market. There is some risk over there, but we have been performing in the past few years after coming out of the recession. So it does look like we are more stable right now. So as you said, people might perceive that as a risk, but we have enough justification in the financial numbers to justify that.
Question around the U.S. operation, proceed with option 1 or 2 and divest Fastlane AG, but is there any way to get any money off the table for the shareholders now in the U.S. operation that you would recommend around the real estate or a recap? Anything at all that you think we should be pursuing while we wait to potentially take the company to U.S. market?
We did think about disinvesting or selling off the real estate and leasing it out again. But what is that? We will get some money out of doing that. We will get a lot rid of our assets, but we'll be increasing our operating expenses a lot by doing that. So if that is something which we might want to look at, it might be possible. But our net income projections right now are at around starting off at 1.8%, going up to 3.2% by 2017, if I assume it right. And that will take our net income down over the period of next few years. So if that is an option, it's still an open option, but it's just a decision that we need to make, weighing in some risks over there.
Who's the deal team? Who's in charge of this project?
This is the team right here, all four of us.
Okay. Thanks.
Thank you for your time. Look
Thank you
forward to
very
working with you in the
Thank you.
future.
Thank you.
Let us know next steps.